All right, welcome to the Explainer. Today, we're jumping right into a professional grade protocol for trading gold and silver. We're going to slice right through all that confusion and lay out a clear, logical framework that separates the market's random noise from its true signal.
So let me start by asking you a question. Have you ever had one of those trades? The setup looks absolutely perfect on the chart, just textbook. And then poof, it completely falls apart for no reason you can see? If that sounds familiar, you know just how thin the line between trading and gambling can feel. This explainer is all about getting you firmly on the side of trading.
You see, the core problem, more often than not, comes down to one thing. We're all focused on the wrong information. The real key to consistency is learning to tell the difference between all that distracting market noise and the actual signal that's driving the price. Now, this is going to flip the script on what most of us were taught. We're told to look for chart patterns, moving averages, RSI, but this protocol says that's all just noise. The real signal, the stuff the pros are actually trading, comes from the big economic forces. We're talking about things like real yields, which is the actual return on an investment once you account for inflation, and the overall strength of the US dollar. That's what's really moving the market. And this right here is the fundamental truth of this entire approach. If you skip the big picture macro story, you're literally just reacting to noise. And if you skip understanding the market structure, well, your entries are basically just random guesses. You're flying blind. All right, let's start building this thing from the ground up. This is the first and honestly the most important pillar of the whole protocol, the macro spine. If you get this part right, every single decision you make after this becomes way clearer and way more logical. So before you even think about opening a chart, you've got to be a detective. Answering these 4 questions gives you all the context you need. Are those underlying drivers, yields in the dollar, actually moving? Is there a huge economic report about to drop and shake things up? And what's the overall mood of the market? This is your strategic roadmap. Think of this like a seesaw. You need to burn this simple relationship into your memory. Gold typically has an inverse or opposite relationship with real yields and the US dollar index, the DXY. When yields and the dollar get stronger, gold tends to get weaker, and vice versa. Just understanding this one dynamic can save you from constantly fighting against the market's powerful undercurrent.
Okay, so we've got our macro bias locked in. Now, and only now, do we actually turn to the charts. On the 4-hour time frame, we're looking for one of only 3 distinct market environments. That's it, just 3. Let's break them down. First up is a clean, beautiful trend. This is what it looks like when the big institutions are all on the same page, actively repricing an asset over days. You see these clean, strong moves, a clear series of higher highs and higher lows. The rule here? It's simple. Don't fight it. You only trade pullbacks that go with the dominant macro flow. Second, we have a range. This happens when those macro drivers are flat and the market is basically just waiting. Price gets trapped between a clear floor and ceiling. And here, the strategy completely flips. You want to fade the edges, sell the highs, buy the lows. And you want to avoid chasing breakouts because they are almost always a trap. And the third environment is a repricing shock. This is a violent, one-way street, usually kicked off by some major data release like inflation numbers or a central bank meeting. The absolute #1 worst thing you can do here is try to be a hero and fade it. The rule is simple. Respect the shock, and then wait patiently for a pullback to join that powerful new momentum. So what about all those wicks we see on the charts? Those liquidity sweeps everyone talks about? Well, this quote clears up a huge point of confusion. A wick that takes out an old high or low means absolutely nothing on its own. It only becomes a powerful signal for a reversal if the underlying macro story, what's happening with yields and the dollar, actually agrees with it. Okay, so we've figured out our macro direction and we've classified the 4-hour market structure. So the big question is, how do we find a precise low-risk entry? Well, this is where we funnel down from our big picture view to our tactical timing. Think of it like this. The 4-hour chart is your why. It gives you the strategic reason you should even be looking for a trade. The 1-hour chart, on the other hand, is the when. It gives you the tactical timing for when to actually pull the trigger. You absolutely need both working together. This slide lays out the patient 4-step model for getting into a trade. You don't just jump in at the first sign of a move. No. First, you wait for the 1-hour chart to agree with your bias by breaking its own structure. Then you let it pull back to a key level. But here's the secret sauce. You wait for the second pullback. That first move is very often a fake out, so entering on the second one gives you a much higher probability entry.
Look, a great system is completely useless if you don't have the discipline to follow it. This entire framework is held together by a set of non-negotiable rules. They're designed to protect your capital and build a real consistent edge over time. These are what the protocol calls illegal setups, basically the cardinal sins of this trading style: fading a clear macro-driven trend, trying to trade inside choppy overlapping price where there's no clear direction, gambling on a big news event, and of course, ignoring those macro drivers. Avoiding these is just as important as finding the good setups. So here it is. This is how it all comes together. The entire process gets simplified into this clean, repeatable decision tree. You just follow the steps. 1. Check the macro. 2. Classify the 4-hour chart. 3. Make sure they line up. 4. Wait for the 1-hour signal, and so on. It's a mechanical checklist that takes emotion and guesswork right out of the equation. And that really is the ultimate takeaway from this whole explainer. This professional protocol isn't some magic system that eliminates risk. Nothing can do that. What it does, and what it does incredibly well, is it filters out all the random, confusing market noise. It allows you to focus and trade based on the true underlying drivers of price. And that is where a real edge is found.